All right, welcome everyone. I am absolutely thrilled to have you here for this explainer. Today we are tackling a really fascinating question. How do people actually build, true generational wealth in the AI era? Because as it turns out, it goes way beyond just dumping cash into the S&P 500. So we're going to unpack the exact strategic asset allocations that sophisticated investors use to step out from the safety of basic index funds and really capture that true exponential wealth. Picture this scenario for a second. For the last 5 years, you've been doing everything totally by the book, right? Consistently dollar cost averaging a piece of your paycheck straight into the S&P 500. It feels safe. It feels like the smart move. But then you look at a buddy of yours, someone who started investing at the exact same time as you, except their portfolio didn't just grow, it literally exploded. They're walking away with double, maybe triple your returns. And naturally, you have to stop and ask yourself, did they just take on a completely reckless amount of risk? Or do they know some secret about the future of global wealth that the rest of us just entirely missed? Well, let's dive into section 1, the baseline foundation, and specifically why the S&P 500 isn't always enough to capture exponential growth. To really understand why, we need to establish our baseline. Now, conventional advice screams that a total market index fund is the ultimate bulletproof solution. And honestly, to be fair, over the long haul, the S&P 500 is a phenomenal, absolutely unmatched vehicle for compounding wealth. But here is the catch. Because it tracks the entire market, it almost always misses out on early hypergrowth. Think of building your portfolio like building a championship sports team. If your roster is entirely made up of, really solid, reliable all-rounders, you're going to have a highly balanced team, and for sure you will win a lot of games. That's your S&P 500. It's your rock-solid foundation. But if you want to completely dominate the league, you have to pair that foundation with a world-class, explosive superstar, a generational talent that can just break the game wide open when it really matters. And this dynamic is perfectly captured by what's called the core and satellite strategy. Basically, the vast majority of your capital, your core, rests safely in those highly diversified, stable index funds. We're talking about 85% of your portfolio. Meanwhile, a smaller, highly tactical satellite slice is deployed into high-risk, hypergrowth sectors. This targeted 15%, that is where you position yourself for massive generational upside, all without betting your entire financial house on a single volatile trend. Which brings us perfectly to section 2, the superstars. We're talking semiconductors and the engine of AI. So what is the absolute most critical satellite sector on the radar right now? Well, we have to talk about the physical heart, the vital organ of this entire AI paradigm shift. There's this fantastic saying going around that I think just perfectly captures the reality of the 21st century. If AI is the electricity of the future, then semiconductor companies are the power plants. You see, artificial intelligence is incredibly hungry. It is not just elegant lines of software code. It literally demands billions of complex calculations every single second. Training these massive large language models requires raw, physical computing power on a scale humanity has just never seen before. You simply cannot have the future of AI software without the absolute dominance of physical hardware. The microchip is quite literally the digital oil of our era. But how do you actually invest in this space without just blindly gambling your savings on a single stock? Well, you can track this massive industry using the SOX Index. This index follows the top 30 largest US companies involved in the entire life cycle of semiconductors. By investing in a fund like this, you basically own the entire infrastructure of the AI age. You get the designers, the manufacturing foundries, and the material suppliers, the whole shebang, all in one package. Honestly, it's practically a mandatory hedge on the future of the global economy. Now, what's really fascinating about this underlying tech is the architectural difference that created the undisputed kingmaker of Wall Street, NVIDIA. So for decades, NVIDIA made GPUs for video games, right? But they realized something massive. A standard CPU is kind of like a brilliant mathematician. It solves incredibly complex problems, but sequentially, just one at a time. A GPU, on the other hand, is like a parallel army of thousands of students solving simpler problems all simultaneously. And AI doesn't need sequential depth. It needs massive parallel processing power to crunch through mountains of data. NVIDIA realized this a full decade early, and that is exactly why every major tech giant today is pretty much forced to pay billions just to keep their AI ambitions alive. Let's shift gears a bit to section 3, the defensive line. Traps, titans, and shields. Because look, as an intelligent investor, you can never just stare blindly at the upside. Massive, exponential opportunity always comes paired with massive, unforgiving risk. And in this space, we have to look out for what is known as the cyclical silicon trap. Semiconductors are, at the end of the day, a physical hardware business, which means they go through intense, brutal boom and bust cycles. It goes like this. First, demand explodes, which causes panic buying and surging prices. Next, the foundries inevitably overshoot. They build way too many factories and end up flooding the market with excess inventory. And finally, step 3, prices collapse, profits tank, and these stocks can see brutal 40 to 50% pullbacks. Smart investors calculate this cycle. They absolutely do not buy based on blind enthusiasm, when 10 years of future growth is already priced in. Now, if that kind of cyclical volatility is just too intense for your blood, investors often look to a concentrated alternative, something like the NYSE FANG Plus Index. This focuses purely on the massive tech titans shaping our world, your Apples, your Microsofts, but the crucial thing here is weighing the sheer market dominance and those massive cash reserves against a really severe downside, total reliance on just a handful of massive companies. Because if just one of these giants gets slapped with an antitrust lawsuit or gets out-innovated, your entire portfolio takes a direct hit. And hey, the tech graveyard is absolutely full of giants who thought they were invincible. Just ask Nokia and BlackBerry. Which brings us to the ultimate shield. And honestly, it's kind of a plot twist. Sitting right alongside cutting-edge AI, quantum computing, and complex algorithms, you have sophisticated institutional investors and global central banks quietly hoarding physical gold. Yeah, this ancient metal is making a massive comeback. And why? Well, because it operates completely independently of fiat currencies and central bank money printing. It doesn't pay a dividend, it doesn't build software, its value is derived entirely from trust and scarcity. It is a pure insurance policy. A 5 to 10% slice of gold in your portfolio isn't there to make you rich. It's a shield designed to keep you wealthy when inflation spikes or geopolitical chaos breaks out. All right, moving on to section 4, the coaches, navigating management in the AI age. Okay, so we've got our reliable core, we have our hypergrowth superstars, and we set up our defensive shields. The final strategic decision is figuring out who is actually going to manage this complex roster of assets. When we look at this management showdown, passive indexing is incredible. It's cheap, it's diversified, and it beats like 85% of human pros. But as we said, it misses that early hypergrowth. Active human management gives you an elite thematic edge, but humans have fatal flaws, right? Fear, emotion, greed. When the markets crash, humans panic. So what about the new kid on the block? AI-managed funds. Well, they offer emotionless rebalancing in milliseconds and can process petabytes of data. Sounds perfect, except their fatal flaw is absolutely critical. Algorithms are built purely on historical data. So when an unprecedented black swan event hits, like, say, a sudden global pandemic or a totally left-field systemic collapse, AI models can fail spectacularly simply because they have zero historical blueprint to read from. Which brings us to our final section, Section 5, the ultimate asset, time and the power of compounding. So we've covered the tech, the overarching strategy, the management styles, but I want to bring the focus right back to you, your personal financial psychology, and honestly, the most undeniable mathematical truth in wealth generation. Just consider the number 15 for a second. That number represents a 15-year gap. Imagine two different people. Person A starts investing just $500 a month at age 25. Person B invests the exact same $500 a month in the exact same funds, but they wait until age 40 to start. The person who started at 25 is going to retire with a drastically, exponentially larger fortune. And why? Simply because their money had an extra 15 years to compound. Building generational wealth isn't just about finding the absolute perfect semiconductor ETF. It is about starting as early as humanly possible and letting time do the heavy lifting for you. Which leaves us with this final, really vital question to think about. When the market inevitably plummets and the media noise reaches a total frenzy, will your emotions or your strategy win? Because at the end of the day, investing is a long, highly disciplined psychological marathon. Your greatest enemy isn't going to be a market crash or a wildly volatile tech sector. It will always be your own emotion. The investors who truly build generational wealth are the ones who can filter out the panic, stick to their strategic asset allocation, and just execute their blueprint flawlessly. Do your research, understand your risk, and start building your foundation today. Thank you so much for joining me in this explainer. If you want to keep uncovering the deep strategies and hidden stories that shape our wealth and our collective future, keep learning, stay incredibly focused, and I will see you in the next explainer.